10 years ago, you could look at a chart of the S&P 500 and maybe volume or a MACD or some basic indicator and have a back of the envelope sense of what the condition of the market is. You can't do that anymore because that day-to-day volatility, it's driving you out of that long position that you wanted to keep. And then 3 days later, we're making fresh highs and you got to buy back in.
Welcome to the Market Call Show, where we discuss what's happening in the markets and the impact on your investments. Tune in every Thursday on Apple Podcast, Google Play, Spotify, or wherever you listen to podcasts.
Welcome to the Market Call Podcast. Today, I'm excited to have John Kosar with Asbury Research. John, I have never met you. I've been a chartered market technician since the 1990 dot-com bubble, and we have never met, which is amazing to me. And I'm glad to be able to meet you now, at least virtually.
Yeah, thanks. I started with the MTA back in the I think it was the late 80s. I got involved with the Chicago chapter because I worked on the trading floor back then. I worked at the CME, the Chicago Mercantile Exchange, and I joined. It was the MTA back then. I joined because I felt like I was off in the wilderness. I was really learning about charting, and back when I started on the trading floor, there were no computers on the floor. So you had guys that were walking around the floor with their heads down, doing the point and figure charts. So that's who who the charting guys were, right? Because they were never looking where they were going. They all had their heads down. And so I kind of noticed, I went there when I was 24. And a friend of mine that I used to work out with, I used to lift weights with a guy. And all I knew was his name was Jack. And it's how it is sometimes. Like when you go to the gym, you don't know really, somebody gives you a spot. How's the weather? Or what about those bears? And then you go on with your day. But one day I saw him get into a Porsche Carrera whale tail. And it was parked way at the end of the parking lot. So, him and I walked out together and said, see you next time. And he kept walking. I was wondering where he was going. In the last spot, like where there wasn't a car, like for a block, there was this beautiful Porsche, and it was his. And I asked him, what do you do for a living? And he said, I'm a live cattle broker. And I was, I'm a kid from the suburbs, right? So I'm thinking, oh, does he work at the stockyards? The stockyards had been gone like since the early 70s. So I'm going like, is this guy some kind of a cowboy or what does he do? I had no idea. And to make a long story short, he said, young aggressive guys like you do really well on the floor. You might, if you ever want a job, tell me and I'll get you a job as a runner. And he worked for Shearson Loeb Rhodes at the time. Shearson's gone through a lot of iterations, but it was Shearson Loeb Rhodes back then. He said, if you ever want a job, tell me. And I said, I want a job. And I was managing health clubs at the time, right? So it was fun job for a 24-year-old. I know it wasn't going to be so much fun when I was 34 or 44. So I was kind of looking for something to do. So I went down the floor. I met him on the train at the train station the next day, and that was it. So I saw that the guys that seemed to be making the money, or the guys that seemed to be the most knowledgeable about the markets, were these guys that were walking around with their heads down, scribbling something on a piece of paper. And I found out that it was charting, and the Mercantile Exchange had a library. So, I worked in the cattle market because I worked with him. So that market closed at 1 o'clock or 1:15. Mm-hmm. And so every day after work, I went right to the library and started reading stuff. And I kind of fell in love with it. It made a lot of sense to me. And 42 years later, here I am, right?
Let's see. So back then, was Richard Dennis still around on the floor back then? He was just about gone, wasn't he?
I don't recall that I saw him on the floor physically, but he was
upstairs by then, I think.
He was an influence, though, right? I mean, Richard Dennis, everybody knew who Richard Dennis was. And he had guys working for him. And that was where all the smart guys, right? Those were if you worked for Richard Dennis, you were held in pretty high regard. But I don't know if that was I don't know if that was his heyday. His heyday could have been a little bit earlier in the 70s, but he was certainly a presence at that time.
Yeah, he was just starting to wind it down in the 80s. So you started trading in what year again down there? 80?
Well, I started on the floor in September of 1980.
1980. Okay.
Yeah.
Wow. Okay.
And I worked my way. I started as a runner. I didn't know anything. And I worked my way. I was down there for a total of 17 years. So,
wow.
I got a little better job, and I was a broker assistant. And then I probably did every job down there that you could, except for, the cleanup crew, the guys who swept the floors at the end. I did everything else. I worked on the phones, doing arbitrage, basically having a phone. I think I worked in I worked in the currencies. I worked in the agriculture. I actually was there as a broker assistant the first day that the S&P 500 opened. I was there during the crash. I had started like a little charting service on the floor. So I had customers at the Board of Trade. So I knew a lot of guys in the bond pit. And actually one of my best friends, it turned out to be, he was a soybean broker. So just through starting this little company that I had, and I was supplying these brokers with support resistance levels, really simple, like rudimentary stuff. But it was a nice little side gig for me, and I met a whole lot of people. So, yeah, I was down there for 17 years, and I finally left when it appeared that the Titanic hit an iceberg, and I didn't want to be the last guy off of the ship. It became obvious. We had Globex, and we had the Board of Trade had I can't think of, but there was one from the Board of Trade at that time, and there was Globex, I think was from Mark. I may get those mixed up, but there was 24-hour trading. And, I was getting into I think I was like 40, 45 years old at the time, and banging heads in the pit's a whole lot of fun when you're in your 20s and 30s. Sure. Once you get older, I became much more interested in the bigger picture and not just futures, S&P pit or whatever. And I saw the floor was going away. I mean, I didn't know when, but I certainly didn't want to be the last guy off the Titanic. So I left the floor in the late 90s.
Late 90s. Yeah, that makes sense. You started out in futures. Do you feel like futures helped you kind of understand supply and demand dynamics better than, say, if you had gone right into stocks? And I asked the question because of the leverage factor. It just seems to me like people that were involved with futures kind of get it a little bit more. But maybe it's just my bias.
Well, being on the floor, it gave me I always say that was my college, that was really my college, because there was a lot less what you see in the financial press. There's a lot less three-dimensional chess where if the Fed does this and Putin does that and the election goes this way, and a lot of hand-wringing on what Chairman Powell is going to say tomorrow. It was a lot more practical, maybe less esoteric, and less academic, and a lot more practical. Who's buying? Who's selling? How are people positioned in the market? Very mechanical in that way. I miss the roar, hearing that noise in the pit. You get a sense of which way the pit's leaning, which way, the crowd is leaning. I keep, financial television on all day just so I can get something in my ear that's giving me an idea of which way the wind's blowing. And so
I remember those days calling up the floor. So I worked for a hedge fund. So, and I traded a lot of different futures, primarily the S&P. And that was how we got a sense. called several different brokers that were there and just listened what was going on. And when we were at key levels, we were purely systematic, but when we got to the point, we were working on execution. So it was about, how are we going to enter right now? We know we need to enter or exit, whatever. But, what's the sense of what's happening right now? That's very interesting that you missed that, because you have to kind of find it in a different way. So you have the TV going, maybe you have do something with your technical models so that you can sense it.
I really missed it. Something, it's funny as you talk to somebody, the first thing that they ask you, right, if you're on the floor is, do you know Joe Skolinski? And there's 3,000 guys on the floor, right? So, you don't have a whole lot of chance of knowing Joe Skolinski. But as I talk to you, I've got these images coming back up in my head. One of the things I did, I think it's when I worked for NatWest Markets, is I told you I had this little business, just this little business where I would give floor traders support and resistance levels, so they knew when to get in and out of their trades during the day. And what I ended up doing was I would be in the booth and I would have a customer that says, I've got 300 S&P to buy between now and Friday afternoon. And I would use those levels to buy the dips, try to buy off of the levels, and just kind of keep the charts up. So it may take me a couple of days to get those, or maybe it was 1,000. I don't even remember what the number was. Mm-hmm. But my little bit of charting, and this is, I think, even before I got involved with the MTA, the market technicians, now CMT, was just using that little bit of skill that I had developed and finding those levels to help guys execute monetary amounts of S&P 500 that I couldn't even calculate in my head. You know what I mean? So that was fun to be able to take that and use it real time and help a customer like you on the other end of the phone get really good fills, during, for that execution that they wanted to get done. So that was one of the most fun things I did down there, I think.
It really made a difference back in the 90s. I mean, it was a different world, because we everything was satellite. If you were not, right there, it was not like the way it is today. And a lot of young people who are entering the business don't quite realize that. So getting good fills was harder. So you had to trade in a completely different way. Today is completely different, at least at the micro level. But in other ways, it's exactly the same. So I was going to ask you, like, throughout your career, what are some of the biggest kind of changes that you've seen in how you have to implement or provide technical research to clients over the years?
Such a great question. Within the past 5 to 10 years, the market changed. The day-to-day volatility, right? We're up 70 today. We're down 50 tomorrow, which I believe it's because of all the algorithmic trading that is taking place now. There's a lot of, I've read estimates where 80% of the daily volume, is computerized trading, algo trading. I don't know if that's true or not, something I read on the internet, but there's a lot of noise that there wasn't before. Back in the day, I sound like grandpa, right? But back 10 years ago, you could look at a chart of the S&P 500 and maybe volume or a MACD or some basic indicator and have a back of the envelope sense of what the condition of the market is. You can't do that anymore because that day-to-day volatility, it's driving you out of that long position that you wanted to keep. And then 3 days later, we're making fresh highs and you got to buy back in. And that happens. So that has changed. I've actually built one metric called the Asbury 6, which I started testing all my favorite tactical tools in different sets of 3, sets of 4, and seeing how well they did at keeping me focused on the real trend and away from the noise that you get where we're down 70 today and you blow out of all your longs. And then you have to buy them again 200 higher, or whatever, over the next week or whatever. And so that's the big change. But interestingly, and I hope I'm not rambling on too much, but this is really interesting to me. When I was on the trading floor and I was in the cattle pit, because cattle pit was small enough so you could really see the locals. You got to know who the locals were. The locals were the guys that took the other side of the order, for those that don't know the parlance. But, they were the individual guys. They owned a membership. They stood in the middle of the ring, and the order fillers were up at the top of the ring, top of the pit. And I was there for a couple of years, and I watched these guys, and they would have their little point and figure charts too, and they would know like where the levels were. So these guys were all independent guys, but you would see all of a sudden all 6 or 7 of these locals down in the middle of the pit who were trading for themselves, taking the other side of the orders. They'd all like put their hands out and be screaming and driving the market down, right? So they knew that there were some sell stops underneath that, in that deck. They didn't.
Mm-hmm.
I'm sure they didn't know how many, but because of the chart or some other input, which I don't know what that was, but these guys would start offering it down, right? So maybe the S&P or the cattle was trading at 64.40. They thought that there were sell stops at 63.90, and there was a whole lot of them. So they push it from 64.40 to 63.90 just by offering it down. They'd hit that 63.90, and 2 of the brokers are 500 at 90, right? So they drive it all the way down to 6,300. These guys buy them back at 63.10, 63.20, and then they're gone for the rest of the day. They went to the Cubs game, and they're done. I think that's what's happening now, but it's happening electronically, right? You have this same kind of mindset is, where are the pain thresholds today? Where are those pain thresholds for support? Where are the pain thresholds for resistance? If we can drive them through here, can that start an avalanche? And maybe we pick up 100 index points in the S&P, or, in the SPY, or whatever they might be trading in the Qs. So that's where I think this came from. I think that computerized trading evolved to the point where, with the guys in the cattle pit, with the Jaguars and the houses in Highland Park, we're doing back in the 80s. These guys are doing with much more money and much more stealth today. That's what I think is going on.
Yeah, stealth for sure. In fact, that lies. I was going to ask you about this. I'm glad you mentioned it. You call it a lie detector test, right?
I like to use metaphors. I like to I think people make this very complicated, and it's actually very intuitive stuff. I mean, it really is. I mean, it's fear and greed is at its essence. So like, I'll use, lie detector test for the market. Again, like, don't chase it because we were down 70 today, because the internals or the Asbury 6 are still green. They're still positive. The other one that I use is, when you go into the doctor's office for your annual exam, you've got a nice shirt on, your hair's combed, doctor makes a mental note of what he thinks that your health might be. And then he sits you on the bench, and he's checking your pulse, and he's checking your reflexes, and he's listening to your heart and lungs. And how you look on the outside may not be necessarily how you look on the inside. So that's kind of how I explain those 6 metrics that are in the Asbury 6, kind of how they, so you can make a connection to real life, what that does. And I actually kept that Asbury 6 internal for a couple of years, just to help me. So I wasn't getting faked out. My job's not to get faked out, right? But that's why they hire you. So, eventually it dawned on me, hey, why don't we clean up this, metric and make it visually attractive is the wrong word, but make it, visually palatable, I guess is right. And, and let other people watch that market move, kind of like a dimmer switch, from everything red or negative back to everything green or positive, or waffling in the middle, which tells you you're at an inflection point and you're probably very close to beginning a new directional trend.
Yeah, and there's definitely more noise now. This reminds me of the fact that a lot of the trend followers back in the day, in the 70s on the futures markets, the Richard Dennis types, the turtles, they used very short-term parameter sets. They were using 21 days, breakouts, things like that. On the Donchian, they were using simple Donchian channel breaks, and they were just killing it, cleaning up. And then people started catching on to it, and then Then there was somebody came up with an indicator called the turtle soup indicator, which was basically how to counter off them, because they're hitting levels at certain, they're hitting orders at certain levels, and you just arb it out, because you'll have this like big excitement move, and then it'll just fade out. They faded it, those moves one way or the other. And so that kind of thing is happening, but at a much more micro level. You could see it in the middle of the day. When we send out a block order, we'll send it out to the broker, and then we put algorithms to put them out, right? So it's like, well, our algorithm, I was talking to a trader, he's like, well, our algorithms are fighting those algorithms. So we're trying to figure what's the best algorithm we can use that would fight the best in today's environment right now for that stock. How is that stock working today? Or, in my world, it's more stocks now. In my proprietary account, I trade futures too, but for clients, it's primarily stocks. So it's an interesting, it has definitely changed. In the 90s, I think things were a lot easier. If you could think about how, in terms of not having an initial drawdown after a trade, if you were working in trend following type uh, um, strategies. If you're working with mean reversion type strategies, there's a ton of that going on, and that tends to work until it doesn't work. It's very interesting to see how that works out. So you've seen a lot of the systematic traders go much more longer term in their parameter sets now, and they're using a lot more what they call continuous models rather than discrete models. So they're basically saying, okay, we're going to use a model that is going to scale, and I've started doing that too, because it just helps you with execution. You're heading in a certain direction, and the fundamental guys are still fighting the same issue, right? I mean, but it's definitely changed. It was interesting to hear your viewpoint, because I think your viewpoint was more like directly seeing it. I've never been on the pit. I've never actually directly seen it. The only thing I've seen is the orders immediately go the opposite way after, over time, when they didn't used to. Things used to follow through, and they don't follow through.
Yeah, that's been the most difficult, is the just the day-to-day. Something else that I've seen, again, all of this is anecdotal, and how you perceive it. But when I was coming up, and I was in my middle to late 20s and trying to learn this and read everything I could get my hands on, it was chart patterns and trend lines, and moving averages and support levels. And when I first started to learn the chart patterns, especially the poster boy ones, like the head and shoulders, right? Everybody knows the head and shoulders. Those things worked most of the time. Now they don't. And I, again, conspiracy theorist that I may be, I think that there's a lot of programs out there that use these patterns to draw people in. And then once they're in, they flip it the other way. And now those people have immediate losses, or maybe they had a profit for an hour and a half, and now they're in trouble. And now so that's a way of controlling the herd, turning the herd for short periods of time. I really believe, I call it financial jujitsu, because that's kind of what you're doing, right?
Yeah.
You're trying to use their own weight against them. So I see a whole lot of that. So where I've changed a lot is I've built some models over the years that look at, I have one that tracks the asset flows around the 11 sector spiders. It's called the CEF model. I've got another one called the correction protection model, which is, a lot of clients ask me, is there a way that we can trade the S&P and get similar returns, but with a lot less risk? So it's another model that moves out of the market when it's internally weak, and it moves into the market when it's internally strong. It turns about once a quarter, is the cadence, approximately. But where I was going with that is, if I see a head and shoulders pattern now, and my internal stuff like the Asbury 6 or some of the other stuff I look at, if that's negative, I don't go near it, right? But if I can see that pattern emerge on the chart, like there's giant one in the SOX index now, the Philex Semiconductor Index, a giant inverse pattern. And then I'm seeing that there's money that is flowing into SOX, SOXX. And I see that my internal models are showing internal strength. Corporate bond spreads are narrowing. The market is calming itself to a place where you could really have a trend beginning. Those are the ones I pay attention to. So the patterns are still there, but you need another tool, kind of a quantitative tool that tells you if the conditions in the market can support what that pattern is implying. So that's kind of how I use some more mechanical model-based metrics to tell me which are the more classical technical tools that I should pay attention to and which ones I should avoid. I got off the floor and worked for a company called, I don't know if you remember Bridge.
Mm-hmm. Bridge
was part of Knight Ridder. And so it was tough getting off the trading floor, by the way. It was very difficult to get hired. It was very difficult to go from being a trading floor guy to somebody that went to work for a firm. So my half step out of there, was Bridge News. It was Bridge because a guy there who ran it in Chicago, he knew who I was. He knew I was a good technician and hired me. But that's a whole other story that, we may or may not want to go down that road. But it was very, very difficult for a guy on the trading floor because they saw these guys as, gorillas that, sad to say, but I think the reputation of a guy on the trading floor was really just some guy, some musclehead that pushed people in the pit and filled orders kind of robotically and really didn't know markets and wasn't sophisticated or intelligent enough to make the transition off the floor. And that wasn't just me. I mean, that was like everybody that I talked to that got older and wanted to take their career somewhere else. It was a really difficult deal to get off the floor. So I was fortunate to be able to do that.
Mm-hmm. Yeah. And so did you have to learn a lot more skills in terms of just computer programming and
not really, because I was it was reputation. It was just, I wasn't coming from the right place. They would rather hire somebody academic that had less experience than me. Because I think people looked, again, this was my experience. Other people might have a different experience. But for many of us down there, it was, the trading floor people were just kind of, mechanics that filled orders, right? They really didn't understand markets, but rather they were, the mechanic, that would fill their order. The order fillers. You go to the store and you buy something and they give the ticket to the order filler and he goes and brings your mattress out to the front. And that's kind of, I think that was a connotation. So it was difficult. I actually, when I had my little business on the trading floor that I had, I went out and bought myself an Apple IIe. I'm really dating myself now, right? You can probably find one in the Smithsonian Institute now, right? But I bought an Apple IIe, and one of my good friends that I knew outside of the exchange, he was a very early computer programmer. He was interested in it. And, and that's when people were writing little routines in DOS. I mean, this was like really at the very beginning. So I was probably as familiar with computers as a lot of people were, just because I happen to have a friend that was kind of he was a geek. He was just a really smart guy. He understood computers. He was really interested in computers. And I told him, this is what I do for my customers on the trading floor. And he wrote me a little routine, probably in DOS, to compute the moving averages and to compute like a stochastic every day. This was before that, you can get any of this stuff on the internet. So yeah, kind of went down a rabbit hole there, but I don't think, it was because of my lack of skills, but rather the connotation that working on the trading floor was just a bunch of guys from the neighborhood, right, that were filling orders.
Yeah, it's really interesting because if you look at the academic world and you look at a lot of the things that have come out of it, it's basically a lot of it is you can't beat the market. There's no use, just diversify. And, and I learned, so I kind of went, just to give you a little bit of background, I kind of went full circle because I got into the technical world pretty early like around 1986, 1987. I didn't get my CMT until 1990 because it took a while for them. Back then we had to write papers and things like that.
I had to write one too. Yep.
And but when I got into the job, I was in college. I started studying for the CMT when I was in college. But then when I got a job, everybody wanted this CFA thing, so I went down the CFA route. So I kind of went really full board on fundamentals. So it was like, wow, fundamentals are the intellectual high ground. And then the 2000.com bust happened, and I realized that nothing works unless the price is moving in your favor. Doesn't matter how much fundamental analysis you have. So and so my mix of fundamental technical changed, and the reason why I'm bringing this up is because when I was reading your information, is it true that you have some fundamental and economic trend data that you follow as well?
Well, I mean, some of the it's effectively relative performance of many different pairs. Stocks versus high yield bonds is something that I pay attention to. I look at I look at a lot of asset flows that are moving in and out of the various ETFs. It shows me conviction. It's the surrogate for open interest that I had when I was on the futures floor. Open interest is a really great tool for letting you know if what happened that day was just guys trading intraday, or if there's enough conviction there to hold the positions overnight. So I look at that. I look at corporate bond spreads to see if they're widening or narrowing. So there are certain things that I look at that I think go beyond your classic. I'm using more of those kind of tools now. I'm looking at things that aren't part of the technical analysis, that I learned as a young man. And I think by bringing these different tools in and pairing them up like into models. So, because there's no indicator that's right all the time. We all know that. And I think, the trick of this is to get a combination of tools that could, Asbury 6, it's got the rate of change in the S&P 500. Of those 6, that's the only one that directly has to do with the S&P 500. The other one's relative performance, investor asset flows. I'm actually reading right off my website. You have corporate bond spreads, volume, and market breadth are things that the day-to-day trading can't influence as much. In other words, the market could be down 70 today and up 90 tomorrow, which may change the rate of change in the S&P 500 slightly, but it's not going to affect those others. So, so I guess I would say I've brought in a lot more non-classic technical analysis tools because I think you need them now. I think you need to verify what you see on the chart is really what it is, because what you see on the chart is not what you saw on the chart 10 or 15 years ago. There's a lot more day-to-day volatility. And again, I think there's a lot of false breakouts, and the market comes, through a support level and runs everybody out and goes the other way. So there's a lot more verification that I do now using these, let's call them secondary tools. And I think if you don't have that, you find yourself chasing your tail all day long.
Yeah, it's interesting about the flows with ETFs. I haven't done any work with that. I have the data, but just haven't done anything with it. It's like it could be used as a sentiment indicator. There's so many things you could use Bitcoin as a sentiment indicator.
Sure.
Just taking different data sets and then confirming, like intermarket type analysis. So that's really interesting. The struggle that I have there's always this struggle when you're managing money of how systematic do you want to be versus how much of an art you want this to be.
Mm-hmm.
And I think that I tend to lean more towards the systematic.
Yeah.
But there is so much value on the discretionary investing or trading side where you're using these higher level analysis that you could use, like kind of almost like macro analysis, to help you make maybe longer term type trades or to verify a particular signal. And it just depends on your style. It sounds to me like your style is more of the classic technical analysis art, which I think is a very useful part of the discipline. I mean,
I would say the opposite.
Okay.
I'm still watching trend. Your basic technical tools, but what makes them actionable are these models that I've put together. And I
get clear signals. There's a clear signal for the A6, for example.
Yes. And something else that I used to do early in my career, and I don't, forecasting. I think when you're young, if you want to get on television or you want to be noticed, you have to be able to get on television. You have to be noticed by the press, right? And the way you do that is with a forecast. And, what I do now is trying not to, every once in a while, I'll see a chart pattern that it's very obvious. The chart patterns there, like there's one in the stocks index now that suggests that we can move another 15 to 16% higher. So I look at that, but not, I'm going to buy them here and I'm going to look for 16% above the market for my profit, and I'm going to risk 3, so my risk reward is 5 to 1 or whatever it may be. I don't do that anymore. I use that as an idea of what the trade could become, but I'm using, for me, tactical is 21 days. It's a business month. And strategic for me is 63 days, a business quarter. So I'm using tactical tools like the A6 or CPM to tell me where those tactical opportunities are within that 63-day trend. And if the trend goes 83 days or 183 days, well, that's really wonderful. But I don't base expectations on how long this trend could last based on a target that I get from some kind of a technical measurement. That if it's there and I could see it, it's interesting kind of subtext for me, but it's not the reason that I would put a trade on. I would not put a trade on anymore. And I suppose it sounds sacrilegious, maybe from CFD, but I wouldn't put a trade on because of a chart pattern. The chart pattern gives me context, expectations, right? But I wouldn't put like if I saw a chart pattern, a triangle, whatever it might be, I'm not going to put that trade on unless these corporate bond spreads are doing what they're supposed to do. I see assets flowing into the ETFs that represent that. Relative performance versus the S&P is favorable. There's all these other hoops that are much more important to me. So I would say I'm driven a lot more by these, these models that I've built, these, data driven. For me, everything is data now. Been doing this all my life, so there is interpretation there. I mean, I know what I see on the chart, but what gets me in and out of a trade are those data driven indicators that I have developed into different models that tell me when market conditions are favorable for that ETF to go up, or that stock to go up, or that index to go up. And all the chart patterns really do now is give me color. So I hope that's not sacrilegious, but that's the way I do
No,
it.
not at all. No, absolutely. It makes a lot of sense. And well, the chart patterns are actually more debatable. It's hard to actually program chart patterns, and there are some people that have done a pretty good job, done a pretty amazing job programming chart patterns. The research is yet to prove itself out, but at least from what I've seen, I could be completely wrong on that. But that makes a lot of sense. And plus, you don't know how long trends are going to last. I mean, a trend could,
Right there.
you just got to go with it as long as it lasts and manage your risk. When it comes to really managing money, there's a lot of stuff you could talk about in the research world. It's just more entertainment, like you said. It's entertainment.
Oh, it
So
is. It's clickbait. A really good example. Last year was a lousy year for everybody. So our CEF model, I built this model that tracks the asset flows in the 11 sector spiders, which together are basically your S&P 500. And last year, on January the 10th, the CEF model went overweight energy. At that time, on January 10th, there was no reason for me to think energy was going to do well. But there was money going there. According to our model, it showed that there was money flowing there in multiple time frames. So that trend atypically stayed in place. We didn't get out of that overweight until June the 24th. And I think during that period, XLE outperformed SPY by something ridiculous. It was like 40%. Did I have any idea how long that trend was going to last? None. I went there because the money was going there. I stayed there as long as the money stayed. Typically, the money might stay. The sector rotations, as I'm sure you know, have really sped up over the past 5 years. So I need to figure out a way. If I was going to do sector rotation, I needed to get into those trades faster. Because if that trade's only lasting 7 weeks, I can't get in on week 3 or 4 when it's plain as day on the chart because I've missed half that trade. So I started playing around with looking at ETF flows and seeing if there was a way to see the money moving before the money pushes the market into a trend. The moral of that story was I had no expectations when I bought XLE other than the money's going there this week. If next week the money leaves there and goes into Staples, I'm going there right along with it. Rather than forecasting, I'm just trying to follow the money because the money doesn't stay in a bad trade very long, right? The money is constantly looking to find opportunity, and the money is way smarter than I could ever be. So I just try to follow that money. And in that particular case, CEF outperformed the S&P by 12% last year, and that was simply on that one idea. It was in energy from January to June. It was out, and the rest of the sector rotations are outside of a little bit of outperformance last year around Halloween time by technology. I think technology might have had a 5 or 6 week trade of relative outperformance. Everything else was up 3% of outperformance, down 3, up 3. There was a lot of choppiness. There was a few of those that didn't work out real well, but I caught the one tiger that there was in that, in the year by the tail. And it was with no expectations that, I think this is going to last a quarter. I think that this could be the trade of the year. I think oil stocks are doing this, or I think OPEC's doing that. The money is going there, and so am I. And that was as simple as that. I do a lot more of that stuff now, as opposed to trying to come up with this theory in my head. Rates are doing this, and the Fed's going to do that, and earnings are expected to be poor. Therefore, I'm going into the sector. I hear that all day. I don't see how you make any money with that, frankly.
Thank you for saying that, because it sells. It's a good narrative, but if your job is to manage money, that doesn't really work very well, because you have this time. I should say for many people it doesn't work very well. Some people it does. For me, it's never worked very well. that's one of the reasons why I've gone more towards this continuous signaling, because you can actually make relative asset allocation bets or trades, and then you could have multiple systems that are designed to make money in different environments, and then you put them together and you have a better Sharpe ratio, better investment strategy than right now we're talking about just about stocks. But I think what you're doing makes a ton of sense to me, and it is the direction that I think technical analysis has added a lot of value. There's so many things going out now, AI and all these other things. It's kind of fun to see the evolution, and I love talking to like you and people like you, that have gone from the kind of I wouldn't call it the infancy, but I would say the middle stage of the technical discipline. The infancy would be like going way back, right? But
yeah, the Ralph Acamporas, the guys from the 60s, those guys. I mean, I know Ralph, and and John Murphy is another guy from the future side. When I was 25, I wanted to be those guys when I grew up, and it was a different time. And the evolution of this and the intelligence that's gone into this and the bringing in of different inputs is really cool.
yeah.
It's before it was trend lines and moving averages, and it's gotten broader. It's gotten more robust. There's just more inputs coming in there, which allow you to make better decisions.
So you're going to be speaking at the CMT Association's 50th anniversary here coming up. It's a significant milestone for the organization. You're one of the speakers. I know a lot of people maybe have not heard of this, but on April 26th through the 28th in New York, there's going to be a pretty big event, and I'm excited to know that you're going to be there talking about it. About what exactly is your topic?
Enhanced technical analysis with data-driven models.
Love it.
Enhanced technical, kind of just what we talked about. You're still looking at trend. You're still looking at all of the basic technical analysis tools, which all have validity, but you're adding depth and context by bringing in different models that you have tested to perform in certain ways. Like our CPM model is over the past 12 years, it's underperformed the S&P on average by 2% a year, but it's done it with a beta of 0.44. The maximum drawdown is 15% instead of 34 for the S&P, and the standard deviation is 4% and change lower than the S&P. So I fooled around with that data, and I said, well, what happens if we use a leveraged ETF? We use an SSO. In other words, build in some of the risk back in, see
Right.
what that does to the other side of the equation. So now, again, back tested 12 years back, brings the beta up to like 0.88. I think the standard deviation is a couple of percentage points higher, brings that maximum drawdown to 30% instead of 34. But now on average, it's outperforming the S&P by 5.7% a year. So that's fun for me. That's what I enjoy doing, is feeding that in and seeing how you could, it's kind of like a stereo, right? And you're, the old fashioned stereos where you have the equalizers and you can change the sound, you can.
Yeah.
So the next thing we're working on, and my son is coming to work for me soon, full time. And I always say he's the brains and I'm the experience. I'm the old guy with the experience. But what we're really looking forward to doing, and we've already started kind of, fooling around with this, is what if you take a couple of models? Like, what if you take model A and model B, and kind of what you said, this is what kind of got me to think about that, and you put them together and you allocate a $100,000 model portfolio, you allocate 30% to this, 70% to this, brings your beta here, it brings your Sharpe ratio here. You start to turn that dial, and you could hone that into numbers that might be more applicable to certain investors.
This is exactly the formula, the menu. It's like, the menu, I say menu, it's like making a dish, right? You blend these together,
Yes.
the certain spices. So, you said that had a 30% drawdown. So you basically volatility adjusted it up to the S&P, which is great. You get a better return profile for the same amount of risk. But then you could say, okay, let's put a strategy that's designed just for negative markets. Or let's put a futures trend following non-correlated model against that. And your Sharpe ratio, really, your return risk improves a lot. So that to me is the secret sauce of like blocking and tackling and making it work, without a bunch of theoretical stuff, like you said, talking heads and all of that. I'm just the opposite, by the way. I don't have CNBC anymore. I used to have it on, because I'm the type of person. You're more disciplined than me, probably. I'm the type of person. If I hear a bunch of stuff, I'll go investigate it. It's like, oh my gosh, someone's talking about that. That sounds right, and then I'll start going down that rabbit hole. I tend to do better when I to talk to smart people like you one on one, and then just do work.
It's so funny that you said that too, because when I was on the trading floor, I was I would get caught up in it. I was in my 30s, and there's a lot of testosterone and chest bumping that goes on in that room.
Mhm.
So you hear the roar, right? So you run over to that pit and you're looking in there to try to see what's happening, and you're like, I got to jump in. It's like a bar fight in a John Wayne movie, and you got to jump in there, right? So you jump in there and you do this really stupid emotional thing, and you jump into a market because you hear people yelling and you think there's money to be made. All right, so now you say, well, this is my short-term trend. Well, it happens, 4 hours go by and your trend has turned south in a big way, and now it's a long-term trend, right? Well,
Right.
if you look at the long-term chart. So the reason that I'm doing all these models now and building all of these is because I know my Achilles heel is that emotion can really make me do stuff that I'll hate myself for the next 2 weeks. So I don't do anything until these numbers tell me it's safe to go in the water. And when these numbers say, time to get out, pal, I'm gone. And you know what? I'm an older person now. I sleep like a baby. When I was younger, I didn't sleep much because, right, everything is emotionally driven. If you're an emotional person in these markets, you're dog food. You have such a low chance unless you're just a natural. And I've seen guys in the pit like that they don't know anything about markets, but there's something that they have that they could trade, and you didn't know how they did it, but they did it. I'm not one of those guys. I need to be disciplined. I need to have numbers tell me what to do so I can keep my anxiety level down and think. So it's funny you said that, but that's why I've gone to this stuff, because I know I know the kind of person I am and what I need to do to be successful.
Well, I agreed. Me and you are similar because I work better that way too. I was going to mention that I mentioned to you that Peter Brandt was somebody that I've had a lot of conversations with, or I shouldn't say a lot, but I've had quite a few conversations with. And I said, what did Paul Tudor Jones do? And he said, he did everything. He was one of those guys that could do what you were talking about, where he could he could watch things and act. But that's a very rare person. So I think a lot of people would just be, who are in the investment business, would be better served to get out of that as soon as possible, and move more towards this more systematic. And I think it would change the results. But you're right. When you're younger, you want to be that person, right? You feel like that's what you're supposed to be. You're supposed to be stressed out.
And the other thing was, for me, I mean, I grew up in a blue collar family, and all my uncles were blue collar guys, right? And I was always told, if you work harder, you're going to be more successful. Work hard. You know what I mean? Push it to the limit. And when you walk out of the floor of the CME, that thought process will kill you. I mean, I remember trading during the day. It's 9 or 10 o'clock in the morning. Nothing's going on. The markets are quiet. I don't have any ideas. I don't have anything that looks like an opportunity on my chart. But I can't go home at 10 o'clock, right? Because of that mindset. You got to work till 3:30, baby. That's your punch in, you punch out, you take your 30-minute lunch. So instead of going to the beach and having fun or going fishing for the day, I stay and try to make something that's not there, and I go home with a big loss, and I'm kicking myself all the way home. So it's so funny the way this trading markets is counterintuitive oftentimes to what you're taught as a young man, how to be successful. Pushing too hard in this business can really, it can knock you out of the game.
That's right. Well, we could talk forever. I really appreciate your time, and I've learned a lot about how you're approaching things, and appreciate you spending some time with us today. And look forward to seeing you speak in New York.
Look forward to seeing you. Thanks. It was really fun. You asked a lot of great questions. You brought back a lot of memories from over the years. Thank you.
The information in this podcast is informational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision. WealthNet Investments is a registered investment advisor. Advisory services are only offered to clients or prospective clients where WealthNet Investments and its representatives are properly licensed or exempt from licensure.